Welcome to Best 1031 Online, where you will get expert insights into all aspects of tax-deferred 1031 exchange from some of the nation's most well-known commercial real estate professionals, as well as CPAs, accommodators, wealth managers, and others. Here's your host, 1031 Broker James.
Let me tell you something. If you're a practicing commercial real estate broker trying to keep up in today's market, you cannot do it all yourself. I couldn't do what I do without my virtual assistant from CRE Task Wizard. Their VAs are trained specifically for commercial real estate administrative work, which frees me up to focus on revenue-producing activities. If you want your time back and your sanity back, go to CRETaskWizard.com. Tell them 1031 Broker James sent you, and they'll waive your onboarding fee. CRE Task Wizard. Buy your time back. Hello, and welcome to this episode of CPA Chat. I am 1031 Broker James. Thank you for joining me here on Best 1031 Online. With me today, a good friend of mine, CPA Sargis Isavi. Sargis, so good to see you on the show, my friend.
Great to see you, James. Thank you for having me.
You bet. You bet. So Sargis and we met through Provisors. I've had a few of my Provisor buddies on the show here. And Sargis is also with a firm that's been in the Valley for quite some time, gishSEIDEN. So, Marty, why don't you go ahead and tell the listeners about yourself? I called you Marty right now, didn't I?
You called me Marty. There you go.
Yeah, so Marty is a descendant of the original SEIDEN and also a very good friend of mine. But this is Sargis, one of Marty's partners.
Yeah. gishSEIDEN has been around over 85 years. And I've been with Gish for about 10 years. I've been doing this for almost 3 decades. And Marty is, like you said, the son of one of the original founders of the firm, of the company. He's been with the firm 50 plus years. So been a CPA for, like I said, almost 3 decades. And I specialize in trust and estate. That is what I do. That's pretty much 75% of my practice. And by that, what I mean is that when an individual passes, they might either have a taxable estate or a non-taxable estate. If it's a taxable estate, it requires filing an estate tax return, Form 706. Even if it's not taxable, it might need to file a portability. In addition to trust and estate and gift tax returns, I also work on all types of business tax returns, corporations, partnerships, you name it, as well as high net worth individuals.
Right. Why did you pick trust and estates of all the different things you can do as a CPA?
You know, there is so much value in that. Not that it's not, there's no value in other aspects of accounting and tax work, but not too long ago, Marty and I worked on this client. We amended the 706, the estate tax return, and we saved the beneficiaries over $1 million. Now, each beneficiary was so grateful. It's like they wanted to give us a hug. They wanted to send us gifts. I'm like, no, we just did our job. But they were so grateful for us to do what we did for them. You don't usually see that reaction on the business side, or even, when you work on high net worth individuals. So appreciation's there. And also working with estate attorneys, professional fiduciaries, financial advisors. That's where I mostly get my referrals from. I work with them together to come up with an estate plan. It's a great field, and I just fell in love with it ever since I started working on it about, I want to say, 15 years ago.
Awesome. Yeah, those kind of wins for your clients. It's hard to put into words what it's like when you recognize and somebody really appreciates the work you did, and plus having such a financial windfall, really. I mean, to get somebody like that, save $1 million, I mean, that's a significant amount of money.
Oh, absolutely. It makes a world of difference. Absolutely.
Yeah. Okay, so let's dive into these questions that we're going to talk about here. So, as you know, the 1031 exchange is my passion. More than 60% of exchanges fail every year, and I'm out to change that. I love saying this to the CPAs. It's not a tax problem. It's not a procedure problem. It's an education problem. Just not enough people know about the exchange. And if they do, they know just enough to be dangerous, which usually ends up being dangerous, right? So
Yeah.
I really appreciate you being here. This is going to be the first time that I've really gotten into this conversation about, how a 1031 exchange and how it works with a trust. Many of my clients, they don't even hold the property that they're going to relinquish in a trust. So it's all comes down to the planning, which me and my buddy Greg, my QI, we talk about that all the time, that it really can make such a huge difference, but it starts first with just having a plan in place, right? And that includes having an estate plan. All right. So the first question is that $1 million question about swap until you drop is what we call it. Is that a myth or a smart tax strategy? So many savvy investors have heard this. They know what it is. How do you explain what happens to the deferred capital gains from a multiple 1031 exchanges when the owner dies, and how that step up in basis rule impacts their heirs?
Sure. Deferred capital gain from multiple 1031 exchanges generally carry forward during the owner's life through the replacement property's basis. So now, if the owner dies still holding the property, the heirs generally take a basis equal to fair market value at death, which usually eliminates the accumulated deferred 1031 gain for income tax purposes. That's why repeated like-kind exchanges followed by death are commonly referred to as swap until you drop.
Yeah. Yeah, because it's, if somebody does an exchange in their, call it late 50s, early 60s, and in my world, in the net lease world, maybe they get an asset that's, it's got 15 years of term on it. Well, I tell everybody that the net leases, even though they have long term and term is king, it's not necessarily a good strategy to hold on to an asset through the whole term, because as the term gets down towards the end, now you don't know if that tenant's going to stay in the property or not, right? So that's why I like to focus on the new properties, because usually, like a fast food restaurants are usually fast food restaurants for 25, 30, 40, 50 years or more. But in that case, somebody might say, okay, James, you know what? We want to, and maybe they don't like the thing that they traded into. So they're like, you know what? We don't like this. It's not working out for us. So we made a lot of money. Let's sell it and then let's trade up. Let's get something better, something bigger, something with more income. So there might be a second exchange. And yes, the carryover, everything you deferred from the first one gets carried over into the second one and into the third one, and et cetera, right?
Yeah, absolutely. In those instances, keep swapping, like you said, and keep deferring that gain. Yeah.
Right. All right. So the next question, should investors hold title individually in a trust or another entity? When investors are planning both for future 1031 exchanges and eventual estate transfer, what ownership structure mistakes do you see most often?
So when it comes to that, investors should usually be thinking about revocable trust, limited liability company, and other ownership structures earlier rather than later, because late changes in title are one of the most common ways to create Section 1031 problems. Now, some of the recurring mistakes are moving property into a partnership, or that was the question, right? You're asking whether investors should hold title individually in a trust or another entity, correct?
Yeah, regardless if they're going to exchange or not. But obviously, if it is in a trust, because as you know, per the rules, whoever exchanges has to be involved through the exchange from the sale into the replacement property. They have to hold title the same way. It's got to be the same taxpayer, et cetera.
Right. Some of the recurring mistakes that I see are moving property into a partnership or multiple member LLC and losing direct real estate ownership for the 1031 exchange purposes. Now, changing title too close to the exchange and creating holding period or taxpayer identity issues, that's one of the issues I see. Assuming every trust is neutral for tax purposes, and also using specialized structures such as DSTs outside the intended role. Those are some of the issues. Now, the most reliable early planning pattern is usually to preserve the direct federal tax ownership, often individually in a revocable living trust. That's important, revocable living trust, or through a disregarded single member LLC, and to be cautious about introducing additional owners or entity layers before exchange objectives are complete. So those are the things, some of the things that need to be thought about.
Yeah. How far in advance should investors coordinate with you before selling or consider selling an investment property?
There's really no bright line statutory minimum lead time on that, but investors should coordinate estate plan and title structure issues before the sale process starts. Now, before listing the property or signing a sale contract, rather than trying to restructure during the 45-day, 180-day exchange window. So that would be my advice on that.
Okay. What happens when a trust wants to complete a 1031 exchange? So special tax and planning considerations arise when a trust owns an investment real estate and wants to complete an exchange. What are some of those considerations?
So if a revocable living trust owns the real estate, there are no tax consequences. It's treated as if the individual owns the property. The special tax and planning considerations for an irrevocable trust owning the 1031 exchange are primarily ownership and classification issues, not a universal prohibition on trusts. So a trust can exchange investment real estate under Code Section 1031, but the transaction must preserve continuity of the correct taxpayer's investment. It has to avoid converting direct real estate ownership into a non-qualifying partnership type interest, and also ensure that any trust termination or distribution are genuinely independent of the exchange. So if the trust is exchanging into a DST, let's say, the DST must remain a narrowly limited investment trust under Revenue Ruling 2004-86. If the trust is terminating or distributing property to beneficiaries, the termination should be based on the trust document, making the exchange independent of the termination. So the exchange was not done merely to facilitate distribution. In short, trust-owned exchanges are workable, but they require earlier and more careful structuring than a straightforward individually owned exchange. Does that make sense?
Yeah. Yeah. And broke that up, unpacked that really well. Quickly, what's the simple distinction between a revocable and an irrevocable?
Sure. Revocable or a grantor type trust, irrevocable trust, and estate-owned properties all or potentially participate in a 1031 exchange, but they're not analyzed the same way. Grantor type arrangements are generally the most straightforward because the grantor may be treated as the owner of the trust assets for income tax purposes. Irrevocable trusts more often require the trust itself to satisfy Section 1031 and raise more trust-specific related party and classification issues. Now, estate-owned property can also qualify, but administration and distribution facts make the analysis more sensitive. This is how you want to think of it. In each case, the controlling question is not the title label alone, but whether the correct taxpayer is treated as owning and holding the relinquished and replacement real property throughout the exchange. So when you think of it that way, there's less room for error.
Right. Makes sense. And it sounds like in a revocable, there's more control and flexibility than in irrevocable.
Absolutely.
Okay. All right. Next up, going back to this mistake conversation again. So you work with many high net worth families and real estate owners. What are the most costly estate planning mistakes investors make after years of successful 1031 exchanges? I can think of one.
Let's see. The most costly estate planning mistakes after years of successful 1031 exchanges, they're not usually exotic. They're structural in nature. Investors most often get into trouble by assuming basis step up is automatic, changing ownership form too late, moving property into partnership type structures that we talked about earlier, mishandling related party transactions, or even overlooking boot and debt relief, missing rigid exchange deadlines, undervaluing property for estate tax purposes in ways that later cap the basis. So long-term exchange success preserves deferred gain, but only careful ownership, valuation, and transfer planning preserves the expected estate planning benefit.
Yeah. You actually came up with another one. So I know one that with my experience that I've seen, and it doesn't really make any difference whether it's in the estate or not, but that is where they'll sell a property, exchange into a property, then they'll sell their replacement property 2 or 3 years later and not exchange.
Yeah.
And they usually find out that they don't realize that everything that was carried over is coming with them. So depending on what they sold that first time has everything to do with the impact of that second sale is going to be, right?
Very true. Yeah.
The other thing that I see is kind of what we were talking about here, this drop and swap, because there's another definition to drop and swap, right? So drop and swap meaning keep dropping properties and swapping them from others. That's kind of what we're talking about here. But the other drop and swap is when like a family limited partnership owns a property. I get this a lot because they're typically the siblings that inherited a property that's now been in the family for decades, and they inherited it. And so, and this is something too that I'm sure you deal with, is how parents deal with that as far as how they're going to inherit or even gift property, that they make sure they gift it in a way that the kids have flexibility. If they inherit it and it's family limited partnership and there's 3 siblings and 2 of the siblings want to cash out and the other one wants to exchange, and that almost always happens when there's 3, even when there's 2. One wants the cash, one says, no, I want to retain ownership of this. I want to, people forget that wealth is by accumulation, not disposition. So
that's true.
In that case, the third, and I just went through this and they did it right. They had a family limited partnership long before the property that was in question was going to be sold. The younger sibling said, you need to drop me out of the limited partnership and make me a tenant in common, because now if you guys want to cash out, you can, but if I can take my interest and exchange that interest. A lot of people don't do that. And like you said earlier, when you made the point about the timing of that, there's no hard line rule per the code, right, that says you must hold it this long. But everybody, and I'm sure you agree, it's got to be at least a year, if not 2 years, to be safe.
Absolutely. And like you said, that was a perfect example. The tick planning, and you got to do that ahead of time to save that all that heartache later on. Yeah.
Right. All right. Last question. If you owned a highly appreciated property today, what would your tax exit strategy be? So if you personally owned a property that had appreciated dramatically and faced a large capital gain, how would you evaluate the decision between selling and paying the tax, doing another exchange, using a trust strategy, or holding the property for your heirs?
So the decision is usually not which technique is best in the abstract, but which tax regime best fits the owner's actual objectives. My first question is, why are you selling the current property? A taxable sell favors liquidity and simplicity, but triggers current capital gain. A 1031 exchange favors continued real estate investment and tax deferral, but preserves the built-in gain through carryover basis. However, it doesn't provide the owner any cash in their pocket without having to pay capital gains taxes. So a trust strategy can be effective for estate and GST, generation skipping tax planning, but it must be evaluated carefully because moving appreciation outside the estate may reduce the availability of a Section 1014 basis adjustment at death, such as moving the property into a bypass trust. Because as you know, there's no second step up upon passing of the surviving spouse. So
Right.
Holding for heirs is often the most favorable income tax result if the owner can retain the property until death and the property remains eligible for Section 1014 treatment. Now, the legally correct evaluation, therefore, depends on whether the owner values current liquidity, continued deferral, estate tax minimization, or basis adjustment for heirs most highly. So those are the things that need to be considered. While there are strategies to borrow funds from the equity of the relinquished property before the sale or from the equity in the newly acquired property, these take very, very careful planning to avoid pitfalls.
Yeah, because I know if you try to take cash or refi a property that you plan on relinquishing and exchanging out of, you are going to trigger step doctrine, right?
Yep. That boot definitely is taxable and it reduces your carryover basis.
Yeah. So if you were in those shoes of the people we just talked about, what would be your strategy, for you and your family?
So the main factors are whether the owner wants to stay in real estate, how much liquidity and flexibility the owner needs, whether a compliant Section 1031 exchange is realistically achievable, whether boot or debt relief will reduce the benefit of deferral, whether holding until death is even a realistic option, whether the owner's trust planning is aimed at estate inclusion for 1014 section or estate exclusion for transfer tax purposes. In practice, selling is usually the simplicity and liquidity choice, whereas 1031 is the continued real estate and deferral choice. Trust planning is the transfer tax and succession structure choice. And holding for heirs is often the strongest income tax choice if the owner can realistically keep the property until death and remain within that Section 1014. Many moving parts, many scenarios, many things to think about, but that's how I would tackle it.
Yeah. So in the last 15 years that you've been in this conversation, how many times have the parents come to you and said, we really want the kids to have it, and somewhere along the line, whether in that conversation or maybe a couple of years later, they learn, they call you and they say, Sargis, we just found out the kids don't want the property. How often do you hear that the kids don't want it?
Quite often.
Yeah. Yeah. What do they want? What do the kids really want?
Show me the money.
That's right.
Yeah.
They want the cash.
Yeah.
Exactly. All right. So just quick to get your opinion on this. Could Congress ever eliminate the step up in basis, and how should real estate investors prepare if that happens?
So the step up basis regulation started back in 1921. and have had only minor adjustments in the last 105 years. However, Congress could eliminate or materially limit the step up in basis because Section 1014 is a statutory rule that Congress can amend or repeal. There have been proposals in the past to replace it with carryover basis, a realization at death, or narrower anti-step-up rules, even though none of those proposals has displaced current law as of today. For real estate investors, the practical preparation is to keep meticulous basis records, understand how ownership form affects Section 1014 treatment, recognize the trade-off between estate exclusion and basis adjustment, and avoid assuming that long-term 1031 exchange deferral will always be erased at death. If Congress acts, the most consequential issues will likely be transition rules, liquidity treatment for illiquid real estate, because if you got to pay it, you got to start liquidating, and the extent to which any new regime preserves or replaces the current Section 1014 outcomes. So yeah, no one really knows with certainty, but looking at the past, it's unlikely, but it's certainly possible.
Yeah, especially when Congress continues to make the money they make.
Yep. Yeah, and some of the states, as you know, are already assessing estate tax. California is not one of them, but they've been thinking about it.
Interesting.
Yeah.
Interesting. What are some of the states that have?
Some of the states that have, I know Oregon is one of them, and they have a very low threshold, like north of $1 million. So if your estate hits that, now you're paying state taxes to Oregon. So it's insane, yeah. On top of the 40% you're paying to the feds.
Right.
But at least the Fed, you have the $30 million threshold at this point between husband and wife. So it's kind of hard to hit that for many people. But yeah, with Oregon, it's a very low threshold. I don't know many states off the top of my head, but I know that there are various states. I can check and see states with state taxes. So there it is. Hawaii, once you hit 5.5 million. Illinois, 4 million. Maine, 7.3 million. Maryland, 5 million. Massachusetts, 2 million. Minnesota, 3 million.
That's surprising for Massachusetts, because Massachusetts is pretty affluent.
Oregon is 1 million. That kind of makes sense, but you're right. Massachusetts at 2 million. That's pretty low. Vermont, 5 million.
Yeah, Massachusetts is way more affluent than Oregon.
Yeah, Washington.
When you consider demographic and what the earning per capita of the Massachusetts population versus Oregon's population.
Yeah, I would think it would be closer to like what Maine has, 7 million. That would make a bit more sense. Or Connecticut is at 15 million, so same as federal. But yeah, it's there's a lot of states out there that are already assessing that state tax. California is not one of them, but I know they've been having some major shortages, and they're looking for ways.
Yeah, well, and we're about to get a new governor, so
yeah.
All right. Sargis, again, thank you so much. I appreciate you being on here. I can't wait for us to work a case together, because I know my clients will be in fabulous hands working with you. So
you got it, James. Thank you so much for having me on your show. This was great, and looking forward to our future, us working together in the future on cases.
Great. Be sure to tell Marty I said hi, and we'll have him on next time.
I will. Thank you.
All right. You bet.